All right. Today is Tuesday, October 19th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight. And here it is, in focus tonight. No agenda. We're just going to go over news related to the market and the economy. And then we'll go over earnings that we got today. Of course, the earnings previews for companies reporting tomorrow. This will be at the end of the video. But anyhow, let's start with the story of inflation and the supply chain nightmare. Last week, President Biden barked at major retailers like Walmart and Home Depot to speed it up. And he ordered ports to open 24/7 to alleviate the supply chain nightmare. So what are the results so far? The answer is nothing. Total jerk-off. LA port a ghost town much of the weekend despite Biden's goal to move cargo. And the jam log is getting worse by the day with no relief in sight at all. There is a record 100 ships floating off ports in Southern California despite Biden's 24/7 schedule. So the number of ships continues to rack up higher and higher and higher. And by the way, it takes a few days to a week to unload one ship. So you do the math here. It will take at least till next summer to clean the jam log that we have right now. We're not even talking about new ships that are about to dock. We have 100 right now. Let's say the ports open 24/7 and they overwork their employees, they crack the whip, and the unloading time is reduced to 2 days per ship. This will take at least 200 days from now. So once again, the supply chain nightmare will not be over anytime soon until and unless the demand slows down. And is the demand about to slow down when the Fed and the federal government continue to print yayo out of thin air and they flood the market with drugs all over the place to quote-unquote stimulate the economy in the stock market? The problem is they overstimulated the economy in the stock market. And therefore, demand went out of whack and supply is struggling to catch up with the demand that continues to grow higher and higher and higher. But aside from the demand problem, which is being stimulated via drugs, we also have a legitimate shortage of truckers. We need truckers to unload these ships. Otherwise, they're not going to be transported. The goods will not be transported from point A to B. This is a supply chain nightmare. And the job is not worth it anymore. Truckers are retiring. They're quitting. And you cannot just find truckers with a magic wand. It takes weeks, if not months, to train truckers and get them the licenses and certifications that they need to start doing the job. Of course, being a former trucker, there is a lot of demand for guys like me to do the job again. The problem is, we are not interested in the misery once again. I would say a minimum of $500,000 salary, plus benefits, plus health care, plus tickets, plus vacations, and of course, hookers in the house. Otherwise, not interested at all. But all joking aside, we have a massive problem in the economy here. The supply chain nightmare will continue to reduce GDP and stifle consumers in the economy the goods they need the most in this very important upcoming holiday season. Therefore, the problem with inflation is morphing from an economic problem into a political problem. And who is holding the blame, by the way? The Biden administration. Even though you and I know that inflation is always a monetary phenomenon. But now the Fed is throwing Biden under the bus and saying, you know what? Don't look at us for blame here. Blame Joe at the White House. This is his creation. This is his problem. And what is Joe doing, by the way? He's not even aware. Mr. President, would you like to have Jerome Powell as Fed chairman next year? And of course, Biden's response is, didn't Powell die last night? Come on, man. But here we have Guggenheim, Scott Minerd, and he says that Powell is toast. He's done. He's not going to be Fed chairman anymore. And the likelihood is Biden will go with another choice, an alternative, which is either brain dead or boystick. By the way, Jerome Powell, you want to clean up this disgusting dandruff? You're a millionaire, for God's sake. Get yourself some Head & Shoulders. And no, I'm not talking about the Head & Shoulders as a market top, which you're going to use to dump your stocks, huh? We're not talking about that Head & Shoulders. But anyhow, there is no relief in sight here when it comes to inflation because we have a massive labor shortage, and the labor shortage continues to become a bigger problem than anybody anticipated. We have half of nurses saying that they are thinking about quitting the profession within 2 years in a survey. They want higher pay and better staffing to convince them to stay. We're seeing this with nurses, teachers, truckers, pilots, firefighters, Cops all over the place. They're done. The job is miserable. The pay is not worth it anymore. And on top of that, we have draconian jab mandates. And now we have employees all over the country threatening to quit, including cops, by the way. So once again, prepare for the purge, the real-life purge this time around. And speaking of jabs, if you thought it's over, think again, because here it is, we have another one. Scientists are closely tracking a new variant spreading in the UK that could be 10% more infectious than Delta. Scientists are closely tracking a new coronavirus variant called AY.42, whatever that is, a subtype of Delta. Data showed it may be 10% more infectious than Delta. As an expert said, cases are low outside the UK. Dr. Shoe-Polish Gottlieb says, this is of course former FDA chief, current Pfizer bitch, he called for an urgent research on the variant. So the bottom line is, keep those sleeves rolled up. Keep rolling and rolling and rolling, because you're going to need more boosters and more jabs over and over and over and over again. Might as well forgo the sleeve altogether and just buy tank tops. So here's the investment idea. Buy calls on tank tops. And of course, even apes are getting jabbed right now. Zookeepers are asking apes, would you like the jab? To protect you and your other fellow apes. And the apes said, no thanks. We got natural immunity. We don't trust Big Pharma. And the zookeepers offered them banana, and then they said, okay, let's roll the sleeves and get the shot already. And rumor has it, after the shot, the apes suffered a side effect, a rare side effect. And they apparently woke up from the pipe dream of the holy short squeeze that's about to happen at AMC. And they decided to abandon AMC. They're buying puts on AMC right now, and they're buying calls on Dole. This is the trade idea of the day. You might be wondering right now, what happened to AMC? It was trading higher in the morning and then went down 5%. Here's the explanation. The apes are abandoning the ship. Of course, this is all due to the side effects from the jab. But if you thought the apes had it bad, or you're having it bad, my employer, bro, they're having the jab mandates. They're not recognizing natural immunity, and I'm about to lose my job, yada, yada, yada. Be thankful that at least you're not a koala, because down under, the koalas are also having a jab mandate, but it's not for the C or the D. It's for something else that you might be familiar with. Back to college days, Australian koalas to get jabbed against the, we can't say that one either, STI, to save the species. Remember back in college when you woke up after a long night of heavy drinking and lost memories? You go to take a leak in the morning, you look down, the color is a little off, it looks like an engine coolant, and then suddenly you start to feel the burn. Speaking of the burn, we have a political problem here because your dear politicians decided to kick the can down the road when it comes to the budget problem and the debt ceiling. We have until December now to come up with an agreement. Otherwise, the United States of America will fall apart and it will default on its debt. Senator Sanders is in a battle with Senator Manchin. And Senator Sanders, a few days ago, was saying, "This prick Senator Manchin is a bitch for Big Pharma. He doesn't care about the poor and the middle class." And then this happened. He went down and he took a selfie with the Senator Manchin. Of course, perhaps Bernie Sanders is realizing after 80 years in politics that this whole fight for the poor or middle class, that's all garbage. Not gonna work. You want to make it in this business, you sell your soul to Big Pharma. This is at least what Senator Manchin did, and it's paying off. He's sitting right there in his yacht. Yep, we have a senator with a yacht. Meanwhile, the citizens are down there. He's looking down at them with a glass of champagne. Right? And the yacht says, almost heaven. 2 more years, Senator Manchin, and you'll upgrade to actual heaven. A bigger yacht. Speaking of yacht, the sales of yacht and private jets, they're through the roof. Why? Because all of these trillions and trillions and trillions of dollars that the Fed decided to print out of thin air, magically, they floated all the way to the top. The rich, the 1%. Few cents here and there trickled down to us, but magically the majority of the money went upstairs. Of course, this is money stolen, keyword stolen, from this country and the new generation of Americans. They racked up trillions and trillions and trillions of dollars in public debt to make sure that the rich can buy more private jets and yachts. On the other hand, in Main Street, the bums, the poor, the middle class, who cares, right? You bums are paying a lot in rent. Your rent is surging higher and higher and higher. And you know who's capitalizing on all of this, by the way? It's the rich And corporate America, of course. They're scooping up single-family homes on steroids. They want to be landlords. And of course, in doing so, they're pushing prices higher and higher and higher. And they are stifling average Americans, middle-class families, from affording a new home. We have a home affordability crisis in this country because houses are being scooped up by big corporations and wealthy individuals who want to be in the landlord business. And you know what I say about landlords? When I meet somebody and say, "What do you do for a living, bro?" And they respond by saying, "I'm a landlord. I have a bunch of properties and I collect rent." That immediately brings out my inner Joe Goldberg. How about you stop being a pimp for living and actually produce something for the economy, right? Single-family rents are surging and investors are flooding the market. Demand for single-family rental homes is showing no sign of easing up, and that is pushing rents through the roof, especially for the highest priced properties. As a result, investors are now flooding into the market again after falling back a bit during the first year of the COVID pandemic. Nationally, rents rose 9.3% in August, year over year, up from 2.2% year over year increase in August 2020, according to CoreLogic. The Fed says our goal is to average inflation at 2%. Mr. Powell, inflation in rent prices is at a minimum 9.3%. What are you going to do about it? The answer is nothing, because you have no clue what to do. You screwed up, and now somebody's going to inherit your mess and deal with it. And of course, as everything, there is no relief inside here. Don't count on new homes hitting the market anytime soon, because today we got some bad news regarding the housing market. U.S. housing starts fall, permits hit 1-year low as shortages bite. Home builders are getting out of the business here. There is no labor to build anything to begin with. On top of that, material shortages and prices are surging higher and higher and higher. And the BlackRocks of the world are capturing this opportunity by saying, you know what? These bums have no other choice. They're going to have to rent homes, and they're going to have to rent it from us. And of course, these reckless policies from the cabal of central banking across the world is resulting in massive inflation worldwide. Take, for example, New Zealand. They are now facing the biggest inflation in 10 years. And therefore, the central bank in New Zealand is jacking up rates higher and higher and higher. On the other hand, our Fed, the central bank of the world, remains either criminally complicit with the crime of the century. Maybe they want this. They want the misery. They want inflation to go higher and higher and higher, to make the rich richer and bring back the roaring 20s, remember? Or they're aloof to the facts, or maybe they're just stupid. Who knows? Either way, they're creating the biggest inflation crisis since the 1970s. But here we have some hope. Perhaps. It's not actually hope, because the remedy is worse than the illness. We have Governor Waller of the Fed. This is another Fed zombie, of course. And he said the Fed could move forward the timeline for raising short-term interest rates to restore price stability. Ta-da! It's going to happen, folks. Everybody says, oh, the Fed is never going to taper. They're never going to raise interest rates. Jerome Powell says our substantial further progress test is stringent when it comes to raising interest rates. Rest assured, folks, we might taper, but we're never going to raise interest rates higher. I say bullshit. You're going to be forced to raise interest rates way higher, and abruptly, of course. And even the Fed is realizing that this inflation problem is going to cost growth. When growth goes down and inflation rises higher, what do you get? The answer is stagflation. And now we have the Atlanta Fed, who continue to reduce their Q3 GDP forecast lower and lower and lower. Finally, we have something that's not going higher and higher and higher. And this is the GDP of the country. The Atlanta Fed went down from a cartoonish forecast of about 6 to 7% to now only half a percentage point. And soon enough, it's going to go down to minus half a percentage point. Here we go. Here we go. Matter of fact, Goldman Sachs are now waving the flag, and they say, you know what? A substantial economic slowdown awaits us in 2022. Goldman Sachs chief economist. But will this stop Goldman Sachs from the propaganda of pushing the market higher and higher and higher? Rest assured, folks, nothing is going on here. The economy might just slow down. No big deal here. The economy might go negative. We might have a recession. But other than that, everything is fine. And they continue to jack up their forecast for the market higher and higher and higher. You know who else says buy? Continue to buy. Put your blindfold on and continue to buy. It's BlackRock Rick Reader, or Scott Reader, whatever his name is. Mr. Reader says, or sees a lot of stocks at reasonable prices. But rumor has it that Mr. Reader missed his eye doctor appointment 3 times in a row. Of course, Ryder, and BlackRock, they don't get paid if the market goes down, right? But they want you to do the buying, not them. You first. Go ahead, jump off a cliff, and then we'll follow you. Trust us. Let's move on to some earnings reviews. Today we got earnings from Johnson & Johnson, Procter & Gamble, United Airlines, Ulta Beauty, not really. Ulta Beauty issued a forecast, not earnings. And then we have Netflix, of course. So let's go over some of those, specifically the ones that we talked about last night. Starting with Procter & Gamble, this is the slide that I shared with you last night. These are the earnings for last quarter, and we were eyeing the change year over year for net earnings or net losses. And the concern was that margins are shrinking here, even though revenue and earnings are rising higher, but the margins are shrinking. For example, the margins for fabric and home care, baby, feminine, and family care were negative, and we were eyeing the margins for beauty, health care, and grooming. Are they going to improve, or are they going to follow the lead from fabric, home care, and baby, feminine, and family health care segments? Well, here's the answer, because we got the results from last quarter, and guess what? Margins went down. The margins for beauty went down to 2% growth year over year, down from 23% last quarter. The good news is, for the grooming segment, growth went higher, 17% year over year, and last quarter the number was the same, 17% growth year over year. And what about healthcare? What's going on here? The margins went down to 1%. And this is down from 8% last quarter. Again, margins are being reduced and squeezed. When it comes to fabric and home care, margins are still down 12%. This is an improvement from a 17% downside year over year last quarter. When it comes to baby, feminine care, and family, the margins are down 18%. This is a slight improvement year over year from last quarter, where the same segment was down 23%. But all in all, last quarter, the entire company had positive margin growth of about 4%. This quarter, they're having a negative margin growth, down 4%. This is alarming, and you can see right away how the rise of inflation is eating away Procter & Gamble's earnings, and therefore they're responding right away. Procter & Gamble said it will raise prices of some of its grooming, oral, and skincare products in the US. So once again, prepare to pay more for these goods. Next, we have the results from United Airlines. And last night, I shared with you this slide from last quarter. My concern was the growth of fuel expenses year over year and the growth of aircraft maintenance, materials, and outside repairs year over year. Because revenues can grow year over year, no problem, but if the rate of growth in expenses surpasses the rate of growth in revenue, then you got a problem. And of course, United Airlines and their latest release that we got after the bell today tried a cute trick, shall we say, by changing the year-over-year ratios to 2021 versus 2019 ratios, because 2020 is the outlier, yada, yada, yada. This is all garbage, of course. They want to put a lipstick on a pig, and therefore I'm going to fix it for them. Here it is. The rate of growth year-over-year for passenger revenue was up 400%, almost. This is good news, right? The problem is, when you dig in the details, the majority of the revenue growth was for future booking, meaning people took advantage of the dip in airline fares and they bought future travel plans, tickets for future travel plans in the holidays season. Therefore, the likelihood is this passenger revenue number will continue to shrink from this point on. Last quarter, it was up over 500% year over year. Now it is down to 400% year over year. On the other hand, expenses are also growing, shall we say, at a whack. For example, aircraft fuel expenses were up 336% year over year. Likewise, for aircraft maintenance, materials, and outside repairs, this segment was up 300% year over year. On top of that, distribution expenses were up another 411% year over year. So expenses continue to grow higher and higher and higher. Energy prices are surging. The labor shortages are getting worse, and wages are rising higher and higher and higher. Therefore, I remain bearish on airlines, not just United, but all of them. They're not going to survive fuel prices reaching $100 a barrel. Not going to happen. And they say, oh, we can pass the expenses to the consumer. Forget about it. The consumer will travel for the holidays. They will eat the extra cost. But what happened after that? What about Ulta? We did not get any earnings from Ulta, but we got a forecast and the forecast was not that bad in my opinion, but yet the stock went off a cliff and it dropped over 10% today. And this is what happens when your stock is trading out of whack. The slightest disappointment and you will see the forces of gravity at work. What about Netflix, the big one? Last time I checked, the stock is trading down slightly, about 1% or so, no big deal here. But what happened during this quarter? Our main concern was the paid net memberships additions or losses. When we look at the numbers for North America, Netflix added 73,000 paid memberships last quarter. This is an improvement from last quarter, or the quarter before I should say, where they lost 433,000 accounts. And of course, for perspective, during the same quarter last year, Netflix added 177,000 subscribers. So this is a disappointing number. However, the growth remained intact in other regions. For example, in the Europe, Middle East, and Africa region, Netflix added over 1.8 million subscribers last quarter. This is an improvement from the quarter before, where they just added 188,000 subscribers. And of course, for perspective, during the same quarter last year, Netflix added 759,000 accounts. So the growth in the Europe, Middle East, and Africa region is impressive. They're adding 1.8 million subscribers last quarter. When it comes to Latin America, they added 330,000 subscribers last quarter, and this is a disappointing number because the quarter before, Netflix added 764,000 paid memberships in Latin America. Now, you have to put it in perspective, of course. Last year, same quarter, Netflix added 256,000 accounts in Latin America. So this is not great, not terrible. What about the Asia Pacific region? Netflix added 2 million subscribers, a little over 2 million subscribers last quarter. The quarter before that, they added about 1 million subscribers. And last year, the same quarter, the September quarter, they also added 1 million subscribers. So this is a dramatic improvement in the Asia Pacific region, and therefore we have two regions in Netflix, the Europe, Middle East, and Africa, and then the Asia Pacific. Those two regions, accounts are growing. In contrast, accounts for North and Latin America are stalling. Therefore, expect more content, international content specifically from Asia and the Middle East, because these are the highest growing regions for the company. And of course, everybody's talking about this new Korean TV show, Squid Game, whatever the hell it is. I haven't seen it yet. Let me know in the comments if I should see it or pass. And lastly, we'll have another company that reported after the bell, which we did not include in our earnings calendar, which is Brinker. This is the company that owns Chili's. And this warning should send a chill down your spine, because Brinker says labor commodity challenges are impacting margins and bottom lines. And the stock, last time I checked, is down double digits after hours. Here's the problem. We're going to continue to see this story over and over and over again this earnings season. Certain companies will have the luxury, the pricing power of jacking prices higher and passing the extra cost from inflation down to the end customer. In this case, for example, Procter & Gamble. There are other companies, the likes of Brinker, who are already struggling. They're not going to be able to pass the buck down to the end customer. Their margins are going to continue to shrink and shrink and shrink. And before you know it, these companies will experience negative growth once again. What do you think will happen in the stock market when we see more companies experiencing shrinking margins, and some of them will dive down to negative territory? Anyhow, folks, we're moving on to the markets information today, and here we go. The Dow Industrial Average closed in the green by 198.70 points, or a gain of 0.56%. The Nasdaq also closed in the green by 107.28 points, or a gain of 0.71%. The S&P 500 also closing in the green by 33.17 points, or a gain of 0.74%. Moving on to the sector's performance. Today, leading the pack at number 1 and capturing the gold medal, healthcare. At number 2 for the silver, technology. The number 3 for the bronze, utilities. Meanwhile, the laggards of the day led by REITs, defensives, and materials, even though every single sector of the market managed to close in the green. It is really interesting that healthcare is leading the action today. This is usually a defensive, neutral side of the market. When market participants are not sure where to go, long or short, tech or inflation, they park the money in healthcare. What about the advance to decline ratios? NYSE 55% advancing versus 42% declining. The Nasdaq 60% advancing versus 37% declining. Moving on to futures. What's going on here? The dollar is down, or at least was down big in the morning, but it managed to stage a rebound and it closed above a very important support level. Regardless, the dip in the dollar was good for commodities. And honestly, whether the dollar goes higher or lower, we know that crude oil prices will continue to surge higher and higher and higher. And therefore, crude oil prices also closing in the green today with yet another 1% gain apiece for both the WTI and Brent. We also have natural gas prices bouncing higher by a little over 1%. We also continue to watch gasoline and heating oil prices because they continue to surge higher ahead of the holidays and winter season. What about softs? We have massive gains, a rebound day for OJ. And by the way, I went long OJ today, betting on a technical rebound. The futures are oversold, as you can see from the chart, and we're betting for a rebound higher of very extremely oversold conditions. Likewise, it was an upside day for coffee and cotton futures. On the other hand, we saw declines led by lumber, cocoa, and sugar futures. What's going on with metals? Mixed picture, yet a positive day led by palladium, silver, platinum, and gold all closing in the green as the dollar cools down, at least for now. It could be a transitory cooling down, but regardless, it was good for metals prices to catch a rebound, although copper dived down by about 1% or so. So we have mixed messages here for metals. On one hand, we have copper diving down as if copper saying, you know what, the dip in the dollar is not going to last, and perhaps soon enough we will see the resumption of the rally in the US dollar. Then on the other hand, you're going to have silver and gold. Gold remains the mature guy in the room, not doing anything at all, waiting for the dollar to make its move, its final move one way or the other, up or down. Yet silver, platinum, palladium are celebrating and suggesting that perhaps the US dollar will continue to slide down regardless of the resiliency. What about meats? We have a down day for lean hogs and live cattle futures. Meanwhile, feed or cattle futures closing at the flat line. Lastly, what about grains? We have gains led by canola, soybean meal, soybeans, soybean oil, and wheat futures. On the other hand, we have losses led by oats, rough rice, and corn futures. Moving on to the big casino, the options market. What's going on here? Leading the pack at number 1, Apple, the hottest table in the casino, with about 1.5 million contracts exchanging hands today. About 76% of those were calls. And at number 2, Tesla, the souffle, with about 550,000 contracts. About 56.5% of those were calls. And here it is at number 3, AMC, with about 460,000 contracts. About 74% of those were calls. We have elevated activities here for Alibaba, trading around 460,000 contracts. About 74% of those were calls. We are moving on to the unusual activities that took place in the options market today, starting with the ticker NIO for NEO. We have a double trade here. It is the same trader. If you don't like NEO, you can go with XPEV, XPeng. I'm going to cover the NEO one. In this case, they bought the 43 calls for the expiration date, October 29th, with expectations that the name will pop higher by a little over 7.5% or more. By then, they paid about 37 cents apiece to enter this trade. All in all, spending about $1.5 million. And what about the trade for the ticker AVIR? This is a pharmaceutical company and the name was down big today, over 60%. And the reason is their COVID-19 pill did not work as expected and therefore the name is down. But somebody's bidding for a rebound here and some short covering. They're buying the 15 calls for the expiration date, November 19th. With the expectations that the name will rebound higher by more than 8% or so by then. They paid about $1.70 apiece to enter this trade. All in all, spending about $2 million. What about the trade for the ticker FSLY, Fastly? They're buying calls across the board, the 60 calls in this case, for the expiration date November 19, with the expectations that the name will pop higher by more than 21% by then, and they paid about $1.80 apiece to enter this trade. All in all, spending about $1.4 million. At the bottom of the table, what about the ticker AA for Alcoa? They're buying calls here, the 57 calls for the expiration date, November 19th, with the expectations that the name will pop higher by more than 6% or so by then, and they paid about $1.80 apiece to enter this trade. All in all, spending about $1.3 million. Continuing with interesting trades, what about the trade for the ticker NCLH, Norwegian Cruises? They're buying calls here, the 27.5 calls for the expiration date, November 5th, with expectations that the name will pop higher by more than 7.5% by then. They paid about 40 cents apiece to enter this trade. All in all, spending about $250,000. What about the trade for the ticker UPST Upstart? They're buying calls, the 400 calls, and they continue to bid this name higher and higher and higher, by the way. Lots of call options buying in this name. In this case, the 400 bucks calls for the expiration date, you guessed it, this upcoming Friday, October 22nd, with expectations that the name could pop higher by more than 9% by then. They paid about $2.75 apiece to enter this trade. All in all, spending about $1.5 million. What about the trade for the ticker COIN, Coinbase? The tulip market is surging, and therefore Coinbase is also surging higher. We have the debut of the ETF. So far so good, but who knows what will happen in the next few days. In this case, they continue to be positive and bullish for the tulip market to continue to rise higher on the heels of this ETF, and therefore Coinbase will also surge higher. They bought the 350 calls for the expiration date November 5th, with expectations that the name could pop higher by an additional 14.5% or more by then. They paid about $5 apiece to enter this trade. All in all, spending about $2.5 million. Lastly, what about the trade for the ticker CFX? This is for Colfax. An excellent stock, by the way, a classic inflationary name, but somebody's calling a top here by buying the 47.5 puts for the expiration date December 17th, with expectations that the name could drop down by more than 6% or so by then. They paid about $1.65 apiece to enter this trade. All in all, spending about $750,000. And I am leaving the trades for Netflix so you can see it right in front of you. These, of course, are earnings plays. Somebody's bidding for more upside for Netflix, somebody's bidding for a downside, and so far Netflix is trading on the flat line, not moving one way or the other. As we covered the earnings, they're neutral. You have good news from two regions, and you have bad to neutral news from the other two. In all likelihood, the true reaction of the stock will take place tomorrow. So some of these trades might still work. The problem is they paid big bucks for the premiums. The Greeks are not going to be on your side if you buy ahead of time, pre-earnings, and then the stock doesn't move at all. Moving on to the heat map analysis, what's going on here? The healthcare sector is leading the action in the market today. We have massive gains for names like J&J, which reported earnings in the morning. Other names are also enjoying the ride higher, like Merck and Pfizer. I went long Pfizer today via call options trade. I will share with you in the chart analysis why I did so. Aside from the healthcare sector of the market, we have notable gains for Walmart. We have good news for Walmart. Alibaba also surging higher based on options activities. We also have the ticker DE in industrials, Deere, rebounding higher because we have the resumption of the talks between union and the management. We knew right away that when you have over 10,000 workers striking against the company, the management will have no choice but to bow down and hear the demand from union workers. And the likelihood is they will reach a deal. And in this deal, union members will have higher wages and higher benefits. This will be reflected in higher expenses for Deere. What does that mean? Prices for equipment will go higher because management will have to pass the buck from extra labor costs all the way to the end consumer. In this case, it happens to be farmers. When farmers pay more for the equipment from Deere, they're going to hike prices on us, the consumer, who are buying crops and food from them. Inflation has a ripple effect now. It is the super cycle, the superstorm, and it is out of control of the Fed right now. The Fed has one option, which is raising interest rates aggressively to stop inflation from happening. But this will cause a recession and a market crash. So we're going to continue to sit and watch the inflation superstorm taking place. Prices will rise high across the board, folks. There is no end in sight here. The transitory narrative is bullshit. We have already entered a super cycle for inflation. When we look at big cap technology names, Apple, Microsoft, Google, Facebook, and Amazon, you're starting to see the rally in Microsoft, Google, and Amazon frizzling out. But the oversold names, Apple and Facebook, remain intact. And this is what's holding the NASDAQ higher because we have dip buyers ahead of earnings. Likewise, we have short covering ahead of earnings. The names that are down the most will experience bigger and longer rebounds ahead of earnings. But we're getting closer and closer here to the consolidation before earnings, if not some downside action, because yields continue to surge higher. The rally in tech is not sustainable. Moving on to the charts analysis, what do we see here in the SPY 30 minutes chart? The melt up goes on and we're seeing gaps higher pretty much every morning now. What does that mean? The algos are on autopilot buying. The human being is not sure what to do. The human being is not buying or selling. The human being is waiting for earnings to make their decisions. And for now, they're letting the algos do the job, the easy job. Autopilot programmed buying of the ETFs and certain names, and the market continues to grind slowly higher and higher and higher. When the human being shows up, the volume will rise higher, and this move will reverse. Not all of it, but at least 20 to 50%, and the chart will go down to the support of 443 at a minimum. We also have to think about what the algos are thinking, because they eye destination. We thought it would be the gap at around 447, but this gap is closed now, and pretty much every gap in the SPY and the NASDAQ already closed. We're talking about the upside gaps. So there is something else. There is another destination that the algos are eyeing. I can't think of anything else beside all-time highs. Or the most plausible explanation is the algos on blindfolds autopilot buying. And they're going to continue to buy and buy and buy until the human being puts a stop by increasing the volume higher. What will cause the volume to increase higher? The answer is selling. What will trigger selling? The answer is bad earnings. Moving on to the daily chart for the continuous contract on the SPY. What's going on here? We have the pop higher off the reverse head and shoulder formation. The momentum indicators remain intact. They remain positive. They're popping higher. The green columns on the MACD indicator are getting longer and longer and longer. The volume is receding and getting shorter and shorter and shorter. All of these are good signs for the bulls in the market because the algos are doing the job right now, and the algos are indiscriminately buying. We're about to get big ones. We got Netflix. We're gonna get Tesla, and next week we will get the big ones, the big cap technology names. The rebound was expected to begin with due to the technicals, the oversold conditions, and the anticipation of earnings, the psychological element of short covering and buying ahead of earnings. But right now, the rebound so far is becoming excessive and extreme. What does that mean? It means the hint of any bad news will flush the charts down once again. Moving on to the Qs. 30 minutes chart, the melt-up continues and it is becoming comical and hilarious, by the way. Pretty much every single candle is green. Yet another evidence that the algos, the computers, the robots are doing the buying with blindfolds on. The gap was not the destination. They're eyeing something else. What do we have? We have the neckline from the head and shoulder formation, and then we have all-time highs. Can the market just blast higher without any stop, without any rest? The answer is most likely not, and we are waiting and waiting and waiting and anticipating a pullback and consolidation ahead of earnings. The higher the market goes in this rebound, the riskier it becomes, because you want to head into earnings with bearishness, extreme bearishness. Therefore, the surprise becomes to the upside. Even though these earnings might not be impressive, might not come out impressive, yet the extreme negative sentiment elicit a reaction in these stocks to pop significantly higher. The problem is when the opposite happens. When you head into earnings with stocks surging out of whack, then the risk becomes a surprise to the downside, regardless of how good the earnings are. Moving on to the daily chart for the continuous contract on the NASDAQ. What's going on here? The rebound continues. The momentum indicators remain positive. They're surging higher. A very strong rebound, a very strong reaction from the correction. The volume is receding down, but the move is becoming extreme. It is pretty much a vertical line right now. They're gonna make it frustrating, by the way. They want to make us look like a bunch of fools, betting on a stop or a pullback or a break. What do you know? The market continues to pop higher and higher and higher, gapping higher and higher and higher. And then we see the capitulation from market participants saying that, you know what? This market will surge to all-time highs again. The Fed has our back. You're already seeing that, by the way. If you watch CNBC, this is the sentiment right now. 2 weeks ago, they were crying. It's the end of the world. You gotta have puts. Inflation is rising. The Fed is about to taper, yada, yada, yada. Now, the sentiment is, forget about it. The market is going to go to all-time highs. Inflation is actually good. The Fed remains accommodative, etc., etc., etc. The bears end up capitulating, and the bulls waiting on the sidelines. They follow the lead from algos, and they buy the market, and they go long. And what do you know? That moment, that exact moment, the market tops and it reverses course once again, trading to the downside. Moving on to the IWM 30 minutes chart, what's going on here? We have a semi-bear flag formation that could still play out to the downside, and the IWM flushes down all the way to 223. Another way to look at the chart is a reverse ABC pattern. The problem is, a lot of people look at the Russell 2000 as a leading indicator. If the Russell goes down, then it is just a matter of time before the Qs and the SPY follow the lead of the the Russell 2000 and also trade down. I disagree because the theme so far is NASDAQ trades higher, the IWM lags. When the NASDAQ goes down, the IWM trades higher. It's a polar market, at least for now. Moving on to the dollar, what's going on here in the Dixie? It remains resilient because it flushed down overnight. It was a massive down candle, but the dollar index reversed course right away and it closed above the support of 93.7. The resiliency is evident, as if the dollar says, I'm not ready to go down, I don't want to go down, but reason and logic says, you gotta go down. It's a battlefield for now, and until the dust settles, we don't have clarity of what to do in this market. You cannot have any clarity, and therefore the human being remains on the sidelines while the algos do the job of buying, because the human being wants some guideline. What should I buy? Should I buy the inflationary trade? Well, I would do that if the dollar softens and goes down, breaking the support. On the other hand, if the dollar continues to pop higher, maybe I should look somewhere else. Maybe healthcare, perhaps tech, who knows? But we need clear guidelines, and these guidelines will come from a decisive move in the US dollar and the 10-year yield. And the confusion couldn't be more evident than the chart of gold. Gold tried to go higher, but as the dollar reversed and we saw the hammer pattern in the dollar, we're seeing the reverse hammer in gold. So gold is not sure here what to do until the dollar does the move one way or the other. Do you want to go up? Or do you want to go down? Until then, the chart of gold will remain confusing, and not just gold, by the way, the rest of the market, but gold remains a weak link. I would avoid it, and I will bet that gold will go down, not up, all the way to 1,685. And then I would be interested in buying gold once again. And here's the chart of the 10-year yield. It is popping higher again. This is not a good sign for technology growth and momentum. It's not good for big cap technology names, Apple, Facebook, Google, Microsoft. All of these names would get whacked if yields continue to rise higher, and yields are rising higher and higher and higher. In the case of the 10-year yield, we're seeing an emergence of a bullish trading channel with higher highs and higher lows. And if this continues, yields in no time, by the way, will be trading at about 1.7%. 1.7% will not be good for the NASDAQ. Will be good for financials, but not for the NASDAQ and the tech names. Moving on to the TLT weekly chart, what's going on here in bond prices? If yields are about to surge higher, say goodbye to the TLT. Not interested here. There is a severe loss in momentum. The MACD, the RSI, all in negative divergence territory. In all likelihood, for now, the chart will go down to the support of 134.5, and then we'll take it from there. 134.5 will come hand in hand with the 10-year yield trading at around 1.7 and 1.8%. And here is the chart of the VIX 4 hours chart. We're waiting and waiting and waiting for the pop in the MACD indicator. It looked likely in the morning, but it did not happen, and the VIX traded down. But it is just a matter of time here, folks, before the MACD indicator in the 4 hours chart of the VIX pops higher. When it pops higher, not if, but when it pops higher, we will see a reversal in course for the rally in the SPY and the Qs. This is a chart for Apple, a daily chart. Apple is now trading above 145. It has the reverse head and shoulder formation, and it is lagging the chart of the NASDAQ for now. So Apple could continue to trade higher heading into earnings, and the reason is it got hit harder than Microsoft, Google, and Amazon, meaning that we're going to see more short covering and more buying ahead of earnings. And this is, by the way, also true for Facebook. Apple and Facebook holding the NASDAQ for now. If Apple and Facebook start to trade down, then the NASDAQ will follow through. But perhaps Apple was trading higher based on the newest innovation from Apple, the iMob, and here it is, a cleaning cloth, which will cost you $19. You can buy a bunch of them on Amazon for $8, or you can pay the iMob $19 for a piece of cloth. Of course, the sheepies will buy it because the fabric, bro. It has the Apple logo on it, therefore it deserves the premium. And by the way, Google today released their Pixel 6 smartphone, and here it is, clean. The phone has a screen, it has a battery, has a camera, it has a chip in the story. No XDR, Liquid, Retina, Max Pro, all that garbage from the iMob. Moving on to a 30-minute chart for the Souffle Tesla. What's going on here? This is actually a 1-hour chart, excuse me. The chart is trading out of whack. It's a breakout higher, but we have earnings tomorrow. Those who bought the chart around 750, 740, 800, they will start booking gains ahead of earnings. And this is exactly what they're doing right now because the momentum indicators are highly extended. We also have a semi-head and shoulder pattern, and this is a gift for bears, of course. You buy put options ahead of earnings in a calendar spread, by the way, as I showed you, and you'll do just fine. The pattern so far from Tesla's earnings is the stock trades nowhere, pretty much flat after earnings, no massive upside or downside, and all of these call and put options expire worthless. But in the following week, we see Tesla trading down, and this has been the pattern for over a year now, pretty much every quarter. The expectations are high, Tesla will pop higher, Tesla will crash. What do you know, after earnings, the stock trades flat, and next week, it starts flushing down. Moving on to BTC, tulips, what's going on here? The pop continues. We are now eyeing record highs. In certain charts, BTC is already trading at all-time highs. All eyes were in the new ETF, and the ETF did fine for now, trading higher on the first day. The real test is what happens in the following day. Are we about to see buy the rumor, sell the news? We will get the answer tomorrow. If we see dumping in the ETF and it trades down tomorrow, then the likelihood is we have buy the rumor, sell the news. If not, then we have a bigger phenomenon here in the tulip market, and BTC will probably trade higher, making higher highs. The sustainability of the rally, of course, remains in question, and the reason is we have a lot of challenges regarding the environmental practices in Bitcoin mining. Miners are moving from China to the US, and this will produce a new challenge for governors across the country. Lastly, moving on to AMC, what's going on here? The gap was closed. What do you know? Gap and crap, closing the gap, and then the chart flushes down, closing at the lows of the day. This is a classic reversal signal. A disciplined trader like me closed his calls. I'm not saying I'm betting against AMC right now, but I'm waiting and waiting for confirmation of the reversal, and then I will switch to puts. And here is a bonus chart for the ticker PFE Pfizer. I bought some Pfizer calls today, and the reason is the name is down over 20% top to bottom, and it is severely oversold. I'm betting for a rebound higher. This is the same play, by the way, that I have with OJ and Facebook. Therefore, I bought calls on Pfizer, anticipating an oversold bounce higher with a target of 44. Moving on to earnings previews. What do we have on the calendar tomorrow? In the morning, we have Verizon, Abbott Laboratories, and after the bell, we have IBM, Lam Research, and Tesla. I'm going to skip Verizon. This is a dividend-paying name. If you want to buy Verizon to capture a 4% dividend, lose 10% for the year, have at it. IBM, I'm going to skip that one. It has a problem with Jim Chanos, who called them out for fraud, so all eyes will be on the response from IBM management. But I'm looking for Abbott Laboratories because this is an excellent stock, and I will be looking at the diagnostics segment for Abbott. Last quarter, the growth was up 84% year over year in the international segment for diagnostics, and up 35% in the US. These numbers will be extremely hard to beat, specifically when we have massive vaccinations that took place in the last quarter. Thus, the expectations are less reliance on diagnostics from Abbott. Next, we have Lam Research. What am I looking for here? I'm looking for the gross margins and the operating margins. Last quarter, the number for gross margins was 46%. For operating margins, the number was about 32%. And Lam gave us a guideline here. They're expecting the margins to be the same. If margins go down, then we have a problem. However, the expectations are, realistically speaking, the margins will improve. And the reason is, Lam Research is an infrastructure name in the chips industry. Before you produce chips, everybody's ramping up production to meet the demand. If you want to meet the demand by producing more chips, you need more equipment, and the equipment will come from Applied Materials and Lam Research. Therefore, you got to be really cautious of becoming too bearish on this name. Lastly, what about the souffle, Tesla? What's going on here? What are we looking for in Tesla's earnings? Last quarter's earnings were impressive. Beats across the board with the widest margins possible. For example, revenues were up 98% year over year. The margins were also impressive. The problem with the souffle is they're so secretive They don't even produce any numbers from regional sales. Every other major automotive company produces regional sales. Why is Tesla being so secretive here? But regardless, what I'm looking for is the revenue growth. But it has to be put in perspective because here are the numbers for revenue growth quarter over quarter, and they vary from quarter over quarter because the automotive industry is seasonal, and therefore you cannot realistically expect the same results and the same level of growth quarter over quarter. Therefore, what I'm looking for is the revenue growth for Q3 when you pin it head to head to the revenue growth in Q3 quarter over quarter from last year. What am I talking about here? Q3 2020, the revenue growth was 45% quarter over quarter. I am expecting Tesla to produce 45% growth at a minimum quarter over quarter. And I know what you're going to say. This is not possible. It's not realistic. They're not going to have 45% growth in revenue quarter over quarter. Baloney. The stock is trading at cartoonish levels. The expectations should be really high, extremely high, from a stock trading at a whack at around $1 trillion in valuation. Therefore, I'm not going to be satisfied with anything besides 45% minimum growth in revenues quarter over quarter. Lastly, what do we have on the economic calendar tomorrow? We have a bunch of Fed zombies speaking about wealth inequality, by the way, ironically, of course, because they are the creators of wealth inequality in the country. But they're also speaking about racial inequity and climate change. These are their priorities right now, not the massive inflation problem that we're suffering from this moment, and it is contributing to wealth inequality and racial inequity. Besides that, the most important event is the Fed's Beige Book. With that, ladies and gentlemen, we're done here. I'm beat up. Thank you for watching. Thank you for listening. This is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.